How to align a US LLC plus Colombian SAS. If you don't align them, you could face double bookkeeping, double taxation, or even fines. Today I'll show you how to make them work together, including FATCA and the concept of effective management. Most expats make the same mistake. They open entities in both countries but never connect them. That leads to inefficiency and exposure. The goal isn't to hide money, it's to build a structure that explains why each entity exists and where the taxable activity really happens. 1. Clear roles and intercompany contracts. Step 1. Assign roles. The LLC should manage US activities like marketing, billing, or sales. The SAS should run Colombian operations like local rentals, payroll, or compliance with DIAN and Fontur. Document this with intercompany service agreements, invoices, scope of services, and transfer pricing rules. Without contracts, tax authorities assume you're moving money without justification. 2. Unified accounting and controls. Step 2. Synchronize accounting. Use the same chart of accounts and compatible systems, like QuickBooks. Every intercompany transaction must have supporting evidence, invoices, time reports, payment receipts. That consistency avoids the nightmare of double books. 3. Money flow and classification. Step 3. Plan the nature of the payments. Are they services, royalties, or dividends? Each classification has a different tax treatment. For example, if your SAS pays your LLC for services, Colombia may require withholding tax. If it's dividends, the rates are different. Choosing correctly avoids paying twice. 4. FATCA and CRS. Why banks do report. Here's the big one. FATCA, the Foreign Account Tax Compliance Act. It forces foreign banks to report accounts held by US citizens and residents. Add to this CRS, the common reporting standard used by many countries to automatically share account information. Bottom line, even if you have a Wyoming LLC with a corporate veil, your banks will still report under FATCA and CRS. They collect KYC, know your customer, and UBO data. Trying to stay invisible is not a strategy. It's a liability. 5. Effective place of management. Another critical concept, effective place of management. Many tax treaties define a company's tax residence by where real management decisions happen. If your US LLC is effectively managed from Medellin, board meetings, contracts signed, decisions made, Colombia could argue your LLC is taxable there. That's why you need proper documentation, board minutes, meetings in the right jurisdiction, and proof of where decisions are made. 6. Real risks and red flags. What gets people in trouble? Transfers without contracts, bank movements that don't match declared income, no intercompany invoices, or a bank requesting documentation you can't provide. When FATCA or DIAN comes knocking, evidence is your protection. 7. Practical checklist. Here's your basic checklist. Signed intercompany agreements, invoices and reports to back services, unified accounting across both entities, simple transfer pricing policy, evidence of management location, board minutes, bank documentation, ready for FATCA/CRS. If you don't have these in place, you're exposed. This isn't theory. This saves money and protects you from penalties. If you want a clear action map for your case, book the $87 consultation with Whole. In 55 minutes, we'll show you how to align your LLC and SAS safely. Link in bio. See you there.